Good day and welcome to the Google Inc. conference call. This call is being recorded. At this time, I'd like to turn the call over to Ms. Kim Jabal, Director of Investor Relations. Please go ahead.
Hello, everyone. Welcome to our first quarter 2007 earnings call. On the call with us today are Eric Schmidt, Chief Executive Officer, George Reyes, Chief Financial Officer, Larry Page, Founder and President of Products, Sergey Brin, Founder and President of Technology, Jonathan Rosenberg, Senior Vice President of Product Management, and Omid Kordestani, Senior Vice President of Global Sales and Operations. Eric, George, Larry, and Sergey will provide some thoughts on the quarter, and then we will have Jonathan and Omid join us for your questions. This call is being webcast from our Investor Relations website. Our press release, issued a few minutes ago, is now posted on our website, as well as presentation slides that will accompany today's prepared remarks. A replay of this call will be available within a few hours. Some of the comments we will make today are forward-looking, including statements regarding international growth, possible future benefits from our partner deals, growth in our headcount, future investments in AdSense partnerships, distribution, and content, future product innovations, our expected operating expenses, our expected level of capital expenditures, our expected margins, charges associated with stock-based compensation, and possible future pressure on traffic acquisition cost rates. These statements involve a number of risks and uncertainties that could cause actual results to differ materially from those anticipated by these forward-looking statements. These risks and uncertainties include a variety of factors, some of which are beyond our control. These forward-looking statements speak as of today, and you should not rely on them as representing our views in the future, and we undertake no obligation to update these statements after this call. Please refer to our SEC filings, including our annual report on Form 10-K for the year ended December 31st, 2006, as well as our earnings release posted on our website for a more detailed description of the risk factors that may affect our results. Copies of these documents may be obtained from the SEC or by visiting the Investor Relations section of our website. Also, please note that certain financial measures we use on this call, such as EPS, net income, operating margin, operating income, and our effective tax rate, are expressed on a non-GAAP basis and have been adjusted to exclude charges related to stock-based compensation. In addition, in the fourth quarter of 2006, we removed certain discrete tax items from non-GAAP net income and EPS. Finally, we adjusted our net cash provided by operating activities to remove capital expenditures, a measure we refer to as free cash flow. We report our GAAP results as well as provide reconciliations of these non-GAAP measures to GAAP financial measures in our earnings release. You can obtain a copy of our earnings release by visiting the Investor Relations section of our website. And with that, I'll turn the call over to Eric.
Well, thank you very much, Kim. As everybody can see from the press release, we are ecstatic about our financial results this past quarter. And before I start talking about how well we did this quarter, I'd like to remind everybody, as I have each year at this time, that we're about to enter our seasonally slower summer growth period, and make sure that you take that into account into your various thinking about how our business will grow. Our core business at Google remains very strong and continues to grow. We've seen excellent performance in the U.S. Performance internationally is even better. International growth across many markets confirms the validity of our business model. Build the market, monetization will follow. What's different now is that everyone is thinking more creatively about monetization opportunities simply because they've learned about our successes and failures in past rollouts. So we're getting a combinatoric benefit from that. We're continuing to make significant investments in our core business. Data centers, of course, primarily for speed, comprehensiveness, and usefulness. In engineering to preserve our 70-20-10 model that you've heard many times before. In sales and support, and I should say this globally, by the way, to attract and retain users and advertisers. And in partnerships, of course, AdSense partners, content partners, distribution partners, offline partners. Sometimes I worry that we spend so much time talking about all the new things that we don't focus as much on the core business, especially in our marketing and messaging. And in looking at the quarter, the most important message is that our core business is very strong. It's the core business that is driving our success. Core services are as vital and vibrant, as innovative as they could possibly be. The success of our core business continues to let us take calculated risks in new markets and expand in new products. Geographic, for example, committing to our European expansion, committed to Asia. China, of course, is very important to us, but only one market of many that are now receiving great focus at Google. Extending our business to multiple platforms and formats. In display advertising, DoubleClick, which of course was the subject of our call last week, which all of you participated in. In video, YouTube, hugely successful for us. Video syndication now working well for us. The BBC deal, a historic deal for us this quarter. In mobile, LG and Samsung deals this quarter, driving mobile adoption for the Internet and for Google in many, many good ways. Many partnerships already in place. In the enterprise business, the premier version this quarter, including now docs and spreadsheets. We're also expanding our business to offline media, again, the subject of a lot of discussion. Radio, the Clear Channel deal that we announced on Monday, again, drives sort of the definitive deal to make that business hugely successful for us. In TV, the EchoStar deal, similarly announced very recently, which allows us to do targeted advertising in the television world. In print, the test that we announced a couple months ago is doing extremely well and being expanded as we learn what really works and what does not. Each of these strategies involves creating solutions that benefit both advertisers and users, and it is the synergy between them that we have been able to harness. Targeted, useful, effective advertising will continue to be our mantra. You all know that, of course. Technology and efficiency is the core of our technology approach, and it really does benefit end users. And in fact, if you think about it, user benefit is the most important thing that we focus on. It's how we make these decisions. Our past experiences and our failures, if you will, the learnings that we get, show us what works and what does not. And from our perspective, and I think the forward challenge for the company is simply making these learnings scale globally so very, very quickly. And this is why we're so excited, not just about the quarter, but for the quarters that lie ahead. Now, rather than me talking, maybe, George, you could take everybody through the financials and a lot of the details, which are very impressive.
Hello? Let's go ahead and get started. Thank you very much, Eric, for that introduction. As you can tell, Q1 was a very strong quarter for us with truly impressive growth, driven by our continued leadership in both search and advertising. Gross revenue increased 63% over Q1 of last year to $3.7 billion. Revenue from Google properties was $2.3 billion, representing strong year-over-year growth of 76%. We experienced healthy traffic growth in our Google.com business, both domestically and internationally. Monetization continues to be strong, positively impacted by improvements in our ads in Q1 as well as in prior quarters. As we have discussed in previous quarters, we are constantly innovating to show our users more relevant and targeted ads, which in turn leads to benefits for our advertisers and strengthens our business. The investments in our extensive network of partnerships are also contributing meaningfully to our growth. AdSense revenues increased 45% over last year to $1.3 billion, driven by strong growth across our existing partners as well as launching a few new partners. As on Google.com, our AdSense business experienced very strong traffic gains in the quarter, particularly internationally. I'll go into more detail about our international performance in a moment. Beginning last quarter, we began to disclose the growth in paid clicks. This number includes clicks related to ads served on Google properties as well as ads served on our partner sites. Aggregate paid clicks grew approximately 52% over Q1 of last year and approximately 13% over Q4. I will turn to the geographic discussion. We are continuing to see significant momentum in our international business as we invest in the infrastructure to address our global opportunity. International revenue was 47% of total revenue, or $1.7 billion. As is typical in the first quarter, the UK was particularly strong, with revenues of $578 million and 23% sequential growth, as the travel and finance verticals rebounded as we expected from Q4. Other markets that contributed meaningfully to growth were Germany, France, and Spain, as well as some of our Asian markets like Japan and also Australia. In addition, it is important to note that some of our smaller markets are also performing very well, including Ireland, Brazil, and Korea, which benefited from our partnership with DOM. This demonstrates the diversity of our business and the potential to grow our business even more significantly outside the United States. Turning to TAC, traffic acquisition costs were $1.1 billion. The majority of TAC is related to the amounts paid to our AdSense partners, which totaled just over $1 billion. The increase is due primarily to the growth of more significant AdSense partnerships. As we grow our distribution and AdSense partner network and embark upon new initiatives, we may see additional pressure on TAC rates going forward. TAC related to distribution partners totaled $73 million in Q1. The increase in these traffic acquisition costs is associated with some of our largest distribution deals ramping up. Other costs of revenue increased $38 million over the prior quarter, primarily as a result of increases in depreciation related to data centers, bandwidth costs, and content acquisition costs. Going forward, we anticipate that other costs of sales will increase as each of these line items grow. Turning to operating expenses, OPEX included $184 million in stock-based compensation and totaled $972 million. These included $506 million in payroll-related and facilities expenses, an increase of $13 million over the prior quarter. R&D decreased as a percentage of revenue, primarily due to lower expenses related to company bonuses in the first quarter relative to the fourth quarter, while sales and marketing and G&A were relatively flat as a percentage of revenue. Non-GAAP operating profit, which excludes stock-based compensation, rose to $1.4 billion, with non-GAAP operating margins of 38%, up from 37% in Q4. As we have said in the past, margins may decline as we continue to invest heavily in our business. You should expect continued growth in headcount across functions and across the world. We also expect continued investments in AdSense partnerships, distribution partners, and content. Capital expenditures for the quarter totaled $597 million. While there were some real estate-related expenditures as in prior quarters, the majority of our CapEx was related to IT infrastructure investments, including data centers, servers, and networking equipment. As we have discussed previously, we expect to make continued significant capital expenditure investments to drive the growth of our business, as these investments have contributed tremendously to our success to date. Now turning to cash flow, operating cash flow was strong at just over $1.2 billion. Free cash flow, a non-GAAP measure which we define as cash flow from operations less CapEx, increased to $623 million. And with that, I'll turn it over to Larry.
Thanks, George. I'm not only excited about our financial performance, but also our product performance in the quarter. And that's what I'm going to tell you a little bit about. Now remember, we keep about 70% of our resources focused on our core business, which is search and ads. And the rest of that, which is probably, the other 30% is probably primarily what you hear about. But we worked tremendously hard to improve our core relevance and our focus on search. And we made many improvements this quarter in many, many different markets on just basic quality and relevance in our search. We've also made user experience improvements, which are easier to see. And those are things like when you do a search, you can actually get maps and reviews and businesses right in your search results. And also in very, very many countries. We released a bunch of new ones this quarter. We're also looking a lot more at context. So things like personalized search, where the results are tailored to you specifically, are things we also made great strides in. Now, we've also, I think, made great strides in moving people towards web computing. And things like Gmail, we opened up sign-ups this quarter and had very healthy growth there, which we're also really excited about. We also improved our docs and spreadsheets product, releasing 15 new languages, and we also had tremendous growth there. We also released Google Apps Premier, which is the product for companies and universities we launched this quarter. It lets you have Gmail for your own domain, and you can even use your own existing login process for your users to log into Gmail and use docs and spreadsheets and all of our great products. And we have a lot of great customers there, Northwestern, even customers in Kenya and Rwanda, and we have pilots at GE and P&G. And we're very excited also about the prospects there. In YouTube, we've had tremendous updates of YouTube, and I'd say the growth, even I feel like, is accelerating even more. And we made many improvements to the site, which increased the use of community features of people talking about videos, rating them, and so on. And just generally improving the tools there and going gangbusters there. And the personalized homepage on Google released a new improved version of that with things like themes, so you can have your personalized homepage on the beach or at the bus station and see a little bit of the weather that's going on. And we had tremendous uptake with huge numbers of our users adopting that on the first day. We also released things like the Google Talk gadget, which lets you see your friends on your Google personalized homepage. And we look forward to improving these products even more. So our user experience is still a tremendous focus for us and new products also. And with that, I'd like to turn it over to Sergey and have him talk a little bit about the other part of our ecosystem, which is partners and advertising.
Thanks, Larry. I'm very excited to talk to you today and to echo a lot of the sentiments that Eric already shared with you, how key partnerships are to Google, how much we care about making our partners successful. So first off, you noted some of the improvements we made to YouTube, and we also have a number more partners there. So in the past quarter, we announced BBC, the NBA, the Sundance Channel. We even have a partnership with a number of the presidential candidates to share their video clips, which we call You Choose 08. And YouTube continues to grow both user-wise, as Larry mentioned, and in terms of partners. In the mobile space, we had a number of new partners sign up and a number of announcements, including Nokia and Vodafone, both two very large announcements. I want to spend most of the time, however, talking about advertising, both what we've done to help out our most numerous partners, our advertisers, as well as the other kinds of partnerships we struck within the advertising space. First of all, we've launched Pay for Action in beta, and that's the easiest way for an advertiser, in many cases, to decide how much they should pay for advertising, which is just to specify an action like a purchase and say, this is how much I'm willing to pay for each purchase. And we're very excited about that. Clearly, it ultimately speaks to what advertisers want to get most. We also have helped them out in getting more of those actions, conversions, purchases, and whatnot with the introduction of the website optimizer. And this lets you automatically test and refine your website to optimize your adoption or conversion, whatever that may be. Another thing that will really help that is to make it easier for customers to actually transact, to spend money without fear of their credit card being stolen, without just a lot of hassle of entering the same information over and over. And we've done that, of course, with Google Checkout. And in this past quarter, we announced a number of new partners for Google Checkout. We launched CompUSA and Blue Nile, and we also signed Radio Shack as well as B&H. Now, we've been talking here mostly about search and certainly online advertising. Within online, we have expanded quite a bit. You're familiar with our AdSense for Content network. We've signed DOM up for that. That's a very large Korean site. And in fact, now we have 75% of the top 20 social networks also in our AdSense network. The big news you've no doubt heard by now is our intent to acquire DoubleClick. And we're very excited about that because of the possibility to make it even easier for our advertisers to launch and manage their search and display campaigns, which they can now do or will be able to do in an integrated fashion. That's the internet portion of our advertising, but of course we also have been trying to make it easier for advertisers to advertise on other media, offline media. In television, for example, we have a partnership with EchoStar over the Dish Network, and that way we can deliver advertisements to Dish Network viewers. And in radio, more recently, we have signed a partnership with Clear Channel, which opens up a lot of great inventory to our advertisers who want to use the radio medium. But ultimately, as Eric says, it really comes down to end users or viewers, to the consumers of this advertising. Some people feel that advertising is a zero-sum game, and they shrug when they hear about all these new advertising products and progress and whatnot. But that's not been our experience. And in fact, that's fundamentally our vision is that we can make advertising better, across the board better for everyone. We don't have to have intrusive or gaudy advertising to be effective. In fact, quite on the contrary, it's the interesting, relevant, sometimes entertaining advertising that is most effective for both advertisers and makes it the best possible world for the users and viewers alike. So on that note, I'd like to turn it over to back there. Well, thank you very much, Sergey. As I listen to this, I am very impressed that the global growth strategy of Google continues to work very, very well. Our innovation model is clearly working. Lots and lots of new products coming out and no end in sight. The partnerships that we reviewed, in particular the ones that Sergey and Larry just highlighted, are now really working. They're really running globally. The core business in search and ads, we're still at the beginning of that business. A lot of people have said that, well, maybe this isn't such a big business. It's a huge business, and we have a lot of room to grow there. The complementary strategies, things like offline ads, some of the new ads initiatives, YouTube, again, complements our core search and ads business. There are other examples. Obviously, our enterprise business, they're working too. I'm personally impressed with the way in which the management team and employees of the company have managed the growth from an operations perspective. You can imagine the dials and everything else that has to be tuned here. And yet we've been able to take advantage of the opportunity before us, and I believe we will be able to do that for the foreseeable future. So with that, why don't we go directly to your questions? And operator, are you ready for the first question?
Absolutely.
And we're going to add Jonathan and Omid as previously announced because they do such a good job with Q&A.
Okay, at this time, if you'd like to ask a question, it is star and 1 on your touch-tone telephone. If you're using a speakerphone, please make sure your mute function is turned off to allow your signal to reach our equipment. Once again, star 1 for questions. And we'll go first to Mark Mahaney with Citigroup.
Great, thanks. 2 quick questions, please. A housekeeping question. It looks like the change or the lowered tax shield on stock-based comp maybe added 3 to 5 cents to the number. Could you just walk through that math a little bit? And then secondly, a broader question just on display advertising. Larry and Sergey, when you started search, you clearly had something different in mind, something more targeted than the normal advertising that was out there. What generally changed in your thinking that made you think either that the display advertising market was big enough or that you had a targetable solution that was good enough to make you want to make the moves you made, like by DoubleClick? Thank you.
Let's have Larry and Sergey answer the second question while they're figuring out the answer to the first.
Yes, Sergey. So there were a number of things that made us excited about this area. And first of all, of course, the success of our own products within the broader advertising space, not just search, but for example, AdSense for content, and more recently even including image ads and things like site targeting. I think we realized how much inefficiency there really was in online advertising, because at the face of it, you would think like, well, how complicated can it be? You just kind of pick a good site for your ads and you just run them, and you know what could be inefficient about that. But in fact, it turns out that there are many different websites. There are many different users who use those websites in their different situations, and advertisers in many cases don't have all the metrics and information they need to decide which ads to run where. So we've seen good success in that, and we think we can expand that more to broader kinds of media, not just static images and whatnot. And of course, with this intent to acquire DoubleClick, we think we can make more advertisers much more efficient.
Larry and Omid and Jonathan, you want to add a little bit more to that?
I think this is Omid. The other thing I would add is that we are, as we've said in the previous quarters, very busy actually with all these initiatives, including display advertising. In the last couple of quarters, we've had lots of customer success stories where they are taking advantage of the content network, the different formats we already support, the targetability. Customers include companies like REI that, for example, use Google's display network to promote new store openings. They utilize geographic and site targeting functionality to reach both mass media sites like NewYorkTimes.com as well as niche audiences like specialty sites like rockclimbing.com. And this has proven so effective for them in driving in-store traffic that they're really going to utilize it as part of their ongoing marketing initiative. So based on what we saw here, we just know that the same principles we apply to search targeting can really extend to these new initiatives, and that we're going to place a lot of emphasis on that.
Yeah, I was just going to add that, we're still in the very early stages of display ads and branding ads and that whole area, and much of the technology we've already developed for our search ads and AdSense for content and so on can be used for those markets. People do very sophisticated things, around time of day and types of users that see things, and also the sites already with their AdSense network, the sites where you just choose to run your ad or not, and so on, the content of those pages, and all those things apply also to the kind of spaces we're now going after.
So could you ask the first part of your question again, the housekeeping question?
Yeah, just on the tax, it sounds like there may have been a little bit of a change in the tax rate you're applying to determine the shield on the stock-based compensation. Or maybe there wasn't a change, but it looks like it was a very modest change. But could you walk through that, or you could just say there was no change?
It was a very, very modest change from the 134 to the 183 here.
Okay, good enough. Thank you very much.
Okay, our next question.
We'll go next to Robert Peck with Teare.
Yes, Eric, I was wondering if you could comment a little bit about some of the tweaks of the algorithm during the quarter. Particularly if you take something like the words Bear Stearns and you type them into Google versus typing them into Yahoo, you notice that you're not monetizing as much as you did. And if you go back a year or so ago, there was a lot of buzz around a third link. And I think you've made some of these changes maybe in the middle of the quarter. Could you talk about what you saw as far as impacts on CPCs, pricing, as you sort of scaled back your inventory on keywords you were selling, click-through rates, and ultimately revenues? And part of that as well is, did you also reduce some of the minimum CPC pricing for more tail-like terms? And you just sort of quantify how you see those changes impacting maybe a more full queue and 2Q and then sort of going forward? Thanks.
Jonathan, why don't you?
Yeah, sure. This is Jonathan. I'm not sure I can quantify it too much for you, but I can try to give you a sense philosophically of what we've been doing and some of the changes that we actually implemented. As you know, we've been incorporating the quality component into ads from the start, and we've been building on that with fairly robust quality improvements almost every quarter since. This quarter was obviously no exception. Some of the type of changes that you're talking about, specifically the ones that we implemented in mid-February, which we announced, were the quality-based bidding changes. And basically what those did was improve the quality score algorithm that generates more accurate quality scores and predictions, particularly in some of the cases where we have limited data. So there are a lot of situations, maybe a lot of people don't search a lot on Bear Stearns. We've done a better job of figuring out for some subset of those words how to tweak the quality-based scores. And that was certainly significant. One of the things that made it even more significant was that we added to the front end of AdWords the ability to give advertisers transparency into their quality so that they could see whether or not particular words were poor, okay, or great. And that actually allowed the results to improve pretty substantially. So that certainly had a real impact during the quarter, although it was only implemented midway through the quarter in February. There were just a couple of others which I can touch on real quickly. We also announced that we changed the background color on the top ads to yellow, and we also changed the area in which people click so that people are less likely to click if they're not actually trying to click on the ad. And these types of things are also important. Landing page quality, I think, is another thing we've been working on. And beyond that, it's basically just many changes to the ad systems. You can derive the CPC piece to the extent that you want by looking at the paid click number, which George announced.
All right, next question.
We'll go next with Anthony Noto
Thank you very much. Eric, I was wondering if you could comment at the management level, as you make investments, what measurement do you look at holistically for the company as a return-based measurement to ensure that the overall business and the overall shareholders are seeing an aggregate return from each of the individual investments? And the reason for my question is that I know that you've launched a lot of initiatives, Google Checkout, Gmail, Google Finance, that may not necessarily have a unique revenue stream tied to them that's large, but it does provide ancillary benefits to the overall platform. And then are you incented on that return metric? And the second question is, we track your revenue per employee on a gross basis. And up until the fourth quarter of 2005, gross revenue per employee had been growing in the single-digit range. And since then, it's been declining, in fact, down 12% year-over-year this quarter. And I recognize that this is because you're adding more new employees that are not productive. At what point do you think your existing employee base is large enough that your new employees do not cause your gross revenue per employee to decline?
An interesting series of questions. We don't approach the questions quite the same way that you phrase them. Our primary focus is on end user happiness, end user traffic, end user growth. And so what we look at is we look at what will drive even more end users using our product globally. So for example, if we can bring out a product that will cause people to use Google and its various applications that much more, and they spend more and more of their day using the Google services, that allows us to eventually monetize that. So we don't insist on a direct link from, say, a product that does not get revenue to one that does. In the cases that you cited, we look at the revenue contribution, but the primary focus and the primary management focus is around end user happiness, end user growth, end user everything. With respect to the revenue per head count, again, we're not very focused on that. We're much more focused in total growth of the platform, total growth of the number of advertisers, total growth of the monetization. And it's easy enough for us to dial any particular metric like employees per gross revenue up or down as we see fit. It's more important to focus on end user happiness. A lot of the people you're talking about are, for example, coming in for customer service globally. We're also way investing in engineering because we believe this is a time where our model is scaling, that products that we're going to bring out in a year or two are going to have huge impacts to the investments we're making in data centers, and we need the engineers to build the great products to do so.
Great, thank you.
Next question.
Thank you. Participants who are asking questions, please limit themselves to one question so we can get through as many as possible. We'll go next to Douglas Andrews with Lehman Brothers.
I was hoping you could comment on toolbar activity. If we look at third-party data, it suggests that toolbar growth is driving north of 40% of total growth in search queries, which clearly validates your distribution strategy. So I'm wondering what you're seeing in terms of the behavior pattern for users with downloaded toolbars, not just right after they get the toolbar, but over a little bit of time. Does it make you concerned at all that we could be seeing sort of a one-time spike from this initial sort of bigger distribution of toolbars? Thank you.
Yeah, this is Jonathan. Certainly a big story in the quarter is traffic, and a component of the traffic performance is certainly toolbar. No question, toolbar users search more than non-toolbar users. I can't really comment on the degree to which the growth rates would be dependent on the number of remaining users out there who could also use toolbar. But we can certainly say that your hypothesis is correct, that toolbar users search significantly more.
This is Larry. I was just going to add, we've been distributing toolbars for a long time and had a very successful product there for a long time. I don't think there's been any huge changes over the last quarter or two in people's behavior or those mechanisms.
Thank you.
Our next question? Our next question will come from Mary Meeker with Morgan Stanley.
Thanks. One of the things that we're seeing in the market right now is it feels as though we're seeing an acceleration in the migration from offline advertising to online advertising. Eric, you talked in your opening remarks about your deal with Clear Channel, your deal with EchoStar, obviously, and others. Obviously, they're early stage, but we're frankly surprised that you were able to announce such large deals as quickly as you've been able to do that. Do you think that we'll see a lot more of those in the next 6 months, and when we add them all up at the end of 2008, and we look at the financial impact to Google, do you think it could be at a level where it's actually material as quickly as the end of 2008? Thanks.
Hi, Mary. This is Amit. Observation is correct. We're very busy in the partnership area, and very much so also globally. And I think what we're seeing is that, again, the power of the platform and the interest in tapping into, depending on what kind of partner you are, both the advertiser network and the publisher network is very interesting for people. And that this push toward more efficiency, measurability, is of great interest to everyone, be it in the print sector, audio, or TV. And that I think what everybody is really trying to figure out is, where do they put their own resources? Just like Google did a while back, where we focused our field operations on more fortune companies. I think the TV companies, print companies, they're all trying to apply their resources to the area of their own expertise, and then utilize our ability to drive a lot of revenue and targetability and measurability. So we are finding great interest. It's very competitive. The market is very competitive, and that on a global basis, we're just again doing the best we can to staff up both on partnerships from legal and finance to be able to model these deals and be able to have the right partnerships in place. So yes, I would say you're going to see us be very much focused on this space. Thank you.
Our next question.
Our next question will come from Ben Schachter with UBS.
Hey guys, congratulations on a nice quarter. Can you talk at a high level on Google's view of cookie data and third-party ad serving? And now that you own DoubleClick, do you think it's more likely that you'll open up the network to third-party ad serving? Thanks.
Larry and Teare.
This is Larry. I think that in general we're really excited about opportunities to improve some of the practices that are in place there with regards to people's privacy, but also while improving targetability and the kinds of information you need to really provide good information to everybody involved in the process. So I think we're excited, I guess, about our ability, our technological strength, and how it can be applied to some of those issues. I don't think, we're not ready to go into any specifics on that yet.
Our next question.
Our next question will come from Justin Post with Merrill Lynch.
Thank you. Could you talk a little bit about TAC? Obviously, you saw the percentage as a percent of network increase quarter over quarter. Is the mix of who your partners are changing a lot? Did a couple partners ramp up? And how do you see that going forward? A little more comments on that. And then on the distribution partner side, is that kind of fully in your numbers now, or are there still more partners ramping up there for future quarters?
Yeah, this is George. So the answer is that we are doing a lot more deals, and the deals are in fact carrying disproportionate amount of tax. So at the end of the day, and I think I suggested that in my earlier comments, TAC as a percentage of revenue is likely to increase given the deals that we're doing these days.
Was there a partner or two that specifically ramped up in the quarter?
Yeah, I can't comment on that. Generally, I think the TAC rates are going up directionally.
Thank you.
Our next question.
We'll go next to Imran Khan with Morgan.
Yes, hi. Thank you very much for taking my question. Your paid click growth rate in Q1 was 52%. I think it was down from 61% in fourth quarter. Can you please help us understand if that growth rate decline was due to query volume growth rate decline or the anniversary of click-through rate improvement? Also, do you have any contra revenue from Google Checkout? Thank you.
George could specifically answer the contra revenue question with respect to checkout. From a marketing perspective, Q4 was seasonally more significant in terms of the marketing efforts that we were doing. He can give you the specific accounting implications. The other specific question relates to paid clicks and click-throughs.
Yes. So basically, paid click declined, growth rate declined from 61 to 52%. Is it driven by query volume growth decline, or there was an anniversary of click-through improvement that you made in the past?
Query volume was very healthy. I think we already mentioned that. Q1 is typically a somewhat weaker seasonal quarter from a monetization perspective, although George mentioned in his prepared remarks that there are some exceptions internationally, particularly in the UK. Beyond that, I wouldn't read too much into an aggregate CPC measure, as we've talked about in the past. Country mix, property mix, as the previous question alluded to, have significant impact on how that shapes up. Clicks are extremely healthy as well.
Okay, on the checkout question, you have to sort of stand back. We really peaked seasonally in the Christmas season, and right now the business is going, but it's not going at a seasonally strong rate at this point in time. So we're bullish on checkout, and the contra revenue range will probably be somewhere around 1% of revenues or thereabouts.
Thank you.
Our next question.
We'll go next to Brian Pitts with Bank of America.
Thank you. First, a broader industry question. When you look at the UK market, a lot of data suggests that market is growing very substantially, north of 40%, and now represents about 11% of total ad spend is now online versus the U.S. we estimate about 5.5%. Can you talk about what's fundamentally different about that market or what's going on there that's driving those higher growth rates? And then just a quick follow-up. You mentioned earlier on the call growth of investment in content. Any sense there what type of content or areas you may be interested in? Thanks.
Hi, this is Amit. In terms of the UK question, we're definitely seeing very strong performance there. I think it's driven by, one, our leadership team and having put a lot of focus in both reaching out to our clients as well as advertising agencies, focus on named accounts. We're seeing increases in average spend, significant increases in that, focusing on the different vertical strategies and making sure we understand the seasonality of those, just as we mentioned earlier. We saw finance and travel bounce back, and in Q4, for example, we very much paid attention to how to deal with that seasonality, and that helped us in Q4 as well. So we just think that, again, the economy is very strong there, and the sales team and the leadership is very strong, and just our ability to execute our strategy is working well. There is also strong interest in the new ad formats that we're sensing, and also, as we mentioned, deals like BBC were some of the very interesting deals we're able to establish. In terms of content, I think in general some of the spending we're doing is improving our product areas. For example, spending in mapping services and mapping data, and some of the partnerships established. But I don't think there's anything unusual there other than just our focus in improving both the products and expanding the partnerships.
This is Jonathan, just adding to Amit's comment. The two other things that I've noticed in the UK are that early on the agencies were particularly aggressive with the online medium, and that really helped spur the early growth when it was in its more nascent stages, which was carried over. I think some of the other observations that I've seen just in the marketing literature are that there's a relative lack of TV advertising there because the BBC is so popular, and so they were much quicker to move their spending to other outlets and try things more quickly and then discovered that the ROI was high.
And George, you wanted to add something, didn't you? I just wanted to clarify that comment on checkout. So on Google Checkout, basically, we're less than 1% of where we were in the holiday quarter.
Great, thanks.
Next question.
Next, we'll go to Krista Quarles with Thomas Weisel.
Hi, I was wondering if you could discuss some of these offline ad partnerships and with regard to your view as to whether or not you can get beyond remnant. Clearly the Clear Channel deal was less than 5%, I think, of their inventory. Or is it really just about redefining remnant for some of these markets? Clearly we've also seen, I guess, the eBay upfront auction not working very well. So I was just wondering if you could discuss that. And then also, I think last quarter you indicated that coverage rates were down. I was wondering if you could comment on them this quarter. Thanks.
This is Eric. One thing to clarify is that Clear Channel deal includes a lot of premium inventory. It's not a remnant deal. That's a misperception. Maybe we didn't communicate that very well. The EchoStar, similarly, those are primary spots. That's why those two deals are so important. It launches these two new initiatives right in front of the primetime viewer. Meter, Jonathan?
This is Amit. I would add that we really look for also how the partnerships would like to start with us. I think we're confident that we're very good at fine monetization given the diversity of our network and the ability of targetability. So, each partnership is different. They're depending on their own sales capabilities and how they like to work with us. We really want to be flexible and find where we can add value to these partnerships. You had a coverage question also?
I'm sorry, what's the other question?
I think you guys indicated that coverage was actually down in Q1 or Q4, and I was just wondering if you could characterize what it looked like in Q1.
So you covered the what?
Ad coverage. Sorry, on the site, it sounded like you were reducing the coverage as a whole across the.
We're showing fewer ads, and those fewer ads are worth more because they're better targeted. Jonathan.
I think what Eric said is correct. Many of the improvements that you're seeing from a quality perspective are improvements that are basically reducing the total number of ads and increasing the click-through rates. And that's really been the hallmark of the ads quality initiatives. And we've been layering them on, as I've said, each quarter after quarter. So the improvements that we came out with in quarters past are further implemented in future quarters. And then again, this quarter, as I mentioned, we implemented a number primarily in the middle of the quarter.
Okay, thanks.
Our next question.
We'll take our next question from Heath Terry with Credit Suisse.
Great, thank you. I was wondering if you could give us an idea, to the extent that you have this data and can share it, of your search users, what percentage are actually using multiple Google products, using Mail, using Frugal, using Orchid, one of the other offerings that you've got, and how much when you look at usage of that entire Google universe as a whole, what percentage of it at this point would you qualify as being non-search?
Sure. This is Jonathan. Probably the most significant change that we've seen there is that we've done a much better job recently of providing a unified login across all of the Google properties. So now what we're seeing is that users who log in tend to use their Google login regardless of which property they're logging in with. And that has manifested itself in terms of one experience that lets us really add a lot of value with personalization, which Larry mentioned we're doing significantly. So we're seeing much, much better integration. In terms of actual percentages of use on different products, we really don't separate the data out that way. But we're starting to see much, much better integration, and we're also starting a number of efforts that will make things like one boxes show up more frequently, as Larry mentioned, so that you'll see the information in context, and sharing of things like addresses and other functionality across all of the products to make it a much more seamless and integrated experience.
Our next question.
Our next question will come from Jordan Rohan with RBC Capital Markets.
Great, thank you. Reports out of the National Association of Broadcasters Conference indicate that Google is supposedly very close to introducing a content filtering system, perhaps called Claim Your Content, for use on YouTube and Google Video. Does this keep copyrighted content from being posted or make it easier to remove? And how might major studios or content producers prove ownership of intellectual property? Thank you.
This is Eric. Those reports did not quite get the gist of what we, in particular, I said. Google is building a tool which is called Claim Your Content, and it allows publishers to somewhat automate the takedown process. It's not a filtering system. The technology does not block uploads. But it makes it much, much more effective and much quicker to download, essentially to get us to remove inappropriately uploaded content. It's very much compliant with the DMCA, and we believe will address many of the operational complaints that people are making about the workload that the DMCA has put on them. So we're trying to make that work, and we think it addresses the vast majority of all of those complaints.
And how do studios prove ownership of the intellectual property?
There's a mechanism where they work with us to show that, and again, these tools are just beginning, and over the next year, these mechanisms will get better and better.
Thank you.
Our next question.
Due to time constraints, we have time for one final question, and we'll go to Youssef Swally with Jefferies & Company.
Thank you very much. I was wondering if you could speak to the disparity in monetization between domestic and international outside of the UK. You may not want to quantify it, but if you can just kind of look at the disparity that you had last year versus this year, by how much has it shrunk, if it has? I'm assuming it has. And can you get to parity over time? Because if that's the case, then could you guys may be in a position to actually show revenue growth?
Well,
revenue growth, sorry.
Yeah, I'm not sure I completely agree with some of the premise of that. We do expect that the international percentage of our global revenue will eventually be greater than 50%. International is getting close already, and that's been one of our strategic goals. It's fundamentally a function of the distribution of worldwide ad dollars, and there's only so much of a percentage in any particular market of worldwide ad spending that we can get. Do you want to characterize, Jonathan, the difference in international between, say, leading markets like the UK and some of the ones? Is the gap getting closer?
I think the way I would sort of look at it is I would look at the strength of revenue in the US and the UK as a proxy for the opportunity set in each of those other countries. The next best thing to look at is the total amount of e-commerce which exists in any individual country. Obviously, the more e-commerce, the more likely that you're going to see significant monetization opportunities. We've done a lot of effort looking at the correlation between GDP, internet hosts, number of computers. My impression is it's generally driven by the big macroeconomic factors, and that's where you're going to see the highest correlations. Some of the much more nascent countries still do have very, very low monetization rates.
Great, thanks.
It's time to finish up. So let me end by saying that first, I thank you all for spending so much time listening to what we're up to, covering us, and helping us get the message out. As I reflect on the quarter and as I reflect on what we talked about today, Google is very much benefiting from the growth rate of the industry and the model that we are using to grow with it or ahead of it. The industry is large, it's growing quickly, all of the players are doing a great job of making the internet and the online and offline experiences even more effective. We've also benefited from the very, very hard work of an awful lot of publishers, agencies, and advertisers who are using tools that can be improved over time. We're investing a lot of money and time to build better platforms, better communities for them. All of this is in pursuit of our goal around end users, making the information that people want accessible to them exactly when and where they want it on the device and in whatever country and language that they choose to be in or that they just care about. So the model is working, and this is a scale business, and the scale looks very, very good to us. So with that, thank you very, very much for all your time, and let's go ahead and we'll talk to you in 3 months.
That does conclude today's conference. You may disconnect your lines at any time.